What if I told you that every dollar in your pocket is part of a massive, invisible machine, one so powerful that it shapes wars, elections, global markets, and even the price of your morning coffee? The financial system of the United States isn't just about banks and money. It's a carefully engineered network of institutions, laws, incentives, and human behavior that determines who gets rich, who stays broke, and how the world economy moves. Most people interact with it every day, swiping cards, checking credit scores, paying taxes without ever truly understanding how it works. But by the end of this video, you'll see the system differently. You'll understand who creates money, how banks really make profits, why debt is everywhere, how Wall Street influences the economy, and what keeps this complex structure from collapsing. And if you enjoy deep, powerful breakdowns like this, make sure you stay until the end and subscribe to QO Documentary, because we're about to uncover the architecture of American finance in a way you've never heard before. To understand the US financial system, we must start with its foundation, money itself. Money in the United States today is fiat currency. That means it has value not because it is backed by gold or silver, but because the government declares it legal tender and people trust it. Trust is the core pillar. Without trust, the entire system would unravel. Every transaction, every loan, every investment depends on collective belief that the dollar will hold value tomorrow. At the center of the system is the Federal Reserve, often called the Fed. The Federal Reserve is the central bank of the United States. It was created in 1913 after repeated financial panics revealed the need for a lender of last resort. Before its creation, bank runs were common. If people feared a bank would fail, they rushed to withdraw deposits, causing the bank to collapse even if it was fundamentally sound. The Federal Reserve was designed to stabilize that chaos. The Fed has three primary tools. First, it sets interest rates, specifically the federal funds rate, which influences borrowing costs throughout the economy. When rates are low, borrowing becomes cheaper. Businesses expand, consumers spend more, and the economy grows. When rates are high, borrowing slows, inflation cools, and growth stabilizes. Second, the Fed conducts open market operations, buying or selling government securities to adjust the money supply. Third, it sets reserve requirements and regulates banks to ensure financial stability. But here's where it gets fascinating. The Fed doesn't print money in the way most people imagine. While physical currency is produced by the Treasury, most money in circulation is digital. When the Fed buys government bonds from banks, it credits their reserves electronically. Money is essentially created through accounting entries. This digital expansion of the money supply plays a massive role in economic cycles. Now, let's talk about commercial banks, the institutions most people interact with daily. Banks operate on a system called fractional reserve banking. When you deposit $1,000 into a bank, the bank does not keep that entire amount locked away. Instead, it keeps a fraction in reserve and lends out the rest. That loan then becomes a deposit in another bank, which lends out a portion again. Through this process, the original $1,000 can expand into several thousand dollars in economic activity. This is how banks create money, not by printing it, but by lending. Loans create deposits. And because loans come with interest, banks generate profit. The entire system relies on confidence that borrowers will repay their debts. If too many borrowers default at once, banks face instability. Beyond banks, the U.S. financial system includes capital marketplaces where investors buy and sell financial assets. The stock market is perhaps the most famous example. Companies issue shares to raise capital. Investors buy those shares hoping their value will rise. When stock prices increase, wealth grows. When they fall, confidence can erode quickly. Bond markets are equally important. The US government funds its operations largely through issuing treasury bonds. Investors lend money to the government in exchange for interest payments. US Treasury securities are considered among the safest investments in the world, which is why they play a central role in global finance. Governments, pension funds, banks, and foreign nations hold trillions of dollars in US debt. This leads to one of the most powerful aspects of the American financial system, the dollar's role as the world's reserve currency, because global trade is largely conducted in dollars, and because foreign governments hold dollar reserves, the United States has extraordinary financial influence. When the Fed adjusts interest rates, it doesn't just affect American borrowers, it ripples across the planet. Another pillar of the system is regulation. After the Great Depression, sweeping reforms were introduced to prevent reckless speculation and protect depositors. The Securities and Exchange Commission was created to oversee stock markets and ensure transparency. Deposit insurance was introduced to guarantee that even if a bank fails, customers won't lose their savings up to a certain limit. These safeguards were designed to restore trust. Yet, despite regulation, crises still occur. The 2008 financial crisis revealed vulnerabilities in mortgage lending and complex financial derivatives. Banks packaged risky home loans into securities and sold them to investors around the world. When housing prices fell and borrowers defaulted, the entire system trembled. Major institutions collapsed. The government intervened with massive bailouts to prevent total economic meltdown. This crisis exposed another critical feature of the system: interconnectedness. Banks lend to each other, investment firms trade complex products, insurance companies back financial contracts. When one piece fails, it can trigger a domino effect. The system is like a web, strong in some ways, fragile in others. Now, let's examine consumer finance. For individuals, the financial system shows up in the form of credit cards, mortgages, student loans, and car loans. Credit is the lifeblood of modern American life. It allows people to buy homes, start businesses, and pursue education. But it also creates long-term obligations. Debt can empower or trap depending on how it's managed. Credit scores determine access to opportunity. A higher score means lower interest rates and better loan terms. A lower score means higher costs or outright denial. This scoring system influences millions of lives, shaping who can buy property, who can rent apartments, and even who gets certain jobs. Insurance companies form another major component. They pool risk. By collecting premiums from many individuals, they can pay out claims to those who experience loss. Whether it's health insurance, auto insurance, or life insurance, these companies help stabilize financial shocks. Pension funds and retirement accounts also play a crucial role. Millions of Americans invest in 401ks and IRAs, placing their retirement savings into stocks and bonds. This creates a powerful feedback loop. The performance of financial markets directly affects retirement security. Then there's Wall Street, the symbolic heart of American finance. Investment banks help companies go public, facilitate mergers, and trade securities. Hedge funds pursue aggressive strategies to generate returns. Private equity firms buy and restructure companies. These institutions move enormous sums of capital daily. But Wall Street is not separate from Main Street. When financial markets rise, consumer confidence often rises. When markets crash, fear spreads. Economic psychology is deeply intertwined with financial performance. Taxes are another essential layer. The government collects income taxes, corporate taxes, payroll taxes, and more. This revenue funds infrastructure, defense, social programs, and interest on national debt. Fiscal policy government spending and taxation works alongside monetary policy from the Fed to guide the economy. When the government spends more than it collects, it runs a deficit. To cover that gap, it borrows over time. Deficits accumulate into national debt. Some argue this debt is manageable because the US controls its own currency. Others warn that excessive borrowing could undermine confidence. Financial technology is transforming the system as well. Online banking, mobile payments, digital investing platforms, and cryptocurrencies are reshaping how people interact with money. Transactions are faster, access is broader. Yet new risks emerge: security threats, fraud, and volatility. Shadow banking is another dimension often overlooked. These are financial activities that occur outside traditional banking regulations. Money market funds, hedge funds, and other entities can provide credit without being classified as banks. While they increase liquidity, they can also introduce systemic risk because they are less tightly regulated. The housing market deserves special attention. Real estate is both a personal asset and a macroeconomic driver. Mortgage lending fuels home ownership. Rising property values build wealth. Falling values can trigger SES. Housing bubbles have historically played a central role in economic downturns. Inflation is another powerful force. When prices rise too quickly, purchasing power erodes. The Federal Reserve targets moderate inflation to encourage spending without destabilizing the economy. Deflation, on the other hand, can be equally dangerous. leading consumers to delay purchases and businesses to cut production. Unemployment, wage growth, and productivity all feed into financial stability. When people have jobs and rising incomes, loan defaults decline and spending increases. When unemployment rises sharply, stress spreads across the system. The financial system isn't a mysterious force beyond your control. It's a structure built by policies, institutions, and human behavior. And while it may seem intimidating, its mechanisms follow logical patterns. If you found this deep dive valuable, if it changed the way you see money, debt, and power, make sure you subscribe to QO Documentary, because the more you understand the systems shaping your world, the more control you gain over your future. And in a system built on knowledge, trust, and calculated risk, understanding is your greatest financial asset.